This episode is brought to you by Katana, a DeFi-first chain built for deep liquidity and high yield. You'll be hearing more from them later in the show. Blockworks Digital Asset Summit, which is crypto's premier institutional event, is back in London October 13th to 15th. It'll have speakers from leading global funds, financial institutions, DeFi protocols, crypto companies, and policymakers. Think BlackRock, Circle, Coinbase, the UK Parliament, Jito and Marinade, all under one roof. Notable names include Joe Lubin from Consensus, Hadley Stern from Marinade, Rebecca Reddick from Jito Labs, a whole bunch of Blockworks folks, and more to come. There's a VIP dinner October 13th, open to speakers and VIP ticket holders only. That will sell out, so act fast. And it's all going down at Old Billingsgate, London. Use the code LIGHT100 for £100 off at checkout. We'll see you there. Nothing said on Lightspeed is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the companies, funds, or projects discussed. Hello, and welcome back to another episode of Lightspeed. I'm here today joined by Chris Hermida. It's a silent H, right?
Yeah, you got it. Don't worry.
Chris Hermida, co-founder of Switchboard. Second time on Lightspeed, I believe, but first time with me. And you're tuning in from the port Miami. Isn't that right?
That is right. We are here at the local Solana workspace. There aren't that many folks still here, but it's a good crowd and a lot of really cool stuff cooking over here. And thanks for having me again, Jack.
Totally. Glad to have you on. That's one I have not been to. I'm here at Blockworks HQ today, all alone, all by myself. But
nice. I mean, before we start, I just have to point out, have you gotten a Seeker yet, or are you still using the flip phone?
Thank you for asking. I do have the Seeker. It's a good phone. I keep it at the office, and I sort of use it as my Wi-Fi enabled notification device. But
okay.
I'm still a daily flip phone user. It was funny, so Solana sent a bunch of journalists the Seeker to review it. And so I used the phone for a few days because I wanted to be able to write a fair review. And at the end of those few days, I was like, ugh, I hate the flip phone or the smartphone. I'm scrolling again. I'm on Twitter all hours of the day. It was bad. So I switched back and yeah, I'm happy with it.
There we go. Yeah, I haven't quite gotten over the Twitter addiction yet. So hopefully at some point I'll be able to do that.
The job's not finished, Chris, until everyone in Solana is using a flip phone. And then the next Seeker will just be a flip phone Seeker. Have you gotten the Seeker, Chris?
Not
to put
yet.
You on the spot here, but
we're waiting for it to be delivered. But I'm excited to
really?
play around with it and for all the cool stuff that people are going to be building on it.
Okay, we're off topic already, Chris. Today we're here not to talk about the Seeker, but we are here to talk about prop AMMs. Something we talk about a fair bit on Lightspeed. It's not new to repeat listeners, but I wanted to bring Chris on the show to talk about this trend, which is a change in the structure of how Solana markets work, which Chris will explain in more detail in a second here. And I wanted to bring you on because I think you have some interesting takes on what this trend is and sort of where it's going. And so I guess I'll just start basic, Chris. Explain to me what prop AMMs are. When did you start noticing them? So obviously Switchboard is an Oracle company. And so this is something that affects your business directly with the way assets are priced. So when did you start noticing these things? And just explain to someone who has no context what prop AMMs are on Solana.
Yeah, so I guess just for background and context, I've been in crypto for quite a bit and worked on some of the largest trading desks in crypto as part of it, and have seen kind of this market structure and evolution from it. I think you can't really get into prop AMMs without seeing kind of the broader context of what's happened. First with, what happened on centralized exchanges and the move towards a lot of different sort of fragmented liquidity, and then just kind of the rise of DeFi and AMMs in general and the volume that's happening there. And then some Solana-specific nuance. I actually hate the term prop AMMs because every prop AMM, if you will, is actually at its core an Oracle AMM, right? There's and if you want to be more specific about that, it's a programmable AMM where there's some logic that can be updated within Oracle, whether it's price, whether it's the curve, whether it's some other components there as part of it. So just going more broadly in that, Oracle AMMs have existed for years on end. And on Solana, there's been Liquidity and others that have existed for quite a while and have used oracles or off-chain data, their own, if you could call it prop, right, their own sort of mechanisms or other mechanisms like Switchboard or like Pith to get a better, fairer price and relay that to those users for pricing trades. The big innovation that's happened, call it over, let's say, it really started in earnest end of last year, has been sort of this evolution of market structure where the majority of sort of retail trading flow on Solana has been going through the aggregators and primarily Jupiter Swap. And then on the other component, you can provide a better pricing experience and have a better product to fulfill orders, at least for large caps, and quote tighter with a prop or AMM or with an Oracle AMM than you can on, say, an order book or some other instruments, just given specific nature of Solana's market structure at the time, given compute units, and just given the way transaction ordering and other things were developing. And so, for a lot of folks, what it's basically meant is, the average retail user, if you're trading, you don't notice it except that your spreads and the price that you're getting filled on, say, a SOL USDC trade is better in a lot of cases than what you might see on a centralized exchange. But from the market maker and sort of liquidity provider perspective, it's a whole new round of competition to provide the best prices in sort of this game on chain to win that order flow while also not being subject to toxic flow. So at a high level, Oracle AMMs prop AMMs are just another way of really providing the best liquidity on chain for those end users via these aggregators.
And one other piece to add maybe is just the way that traditional AMMs determine prices. So like the original Uniswap, I guess Uniswap still, is based on the last trade that happened in that pool of assets. So so there's some like the ratio of token A to token B in the pool. There's just a mathematical constant, and that determines the price. Whereas prop AMMs or Oracle AMMs, as you'd prefer them to be called, Chris, use oracles. And so, the price discovery probably happens on Binance. Mm-hmm. And as quickly as you can sort of pipe the latest price in is, how quickly you can price these assets. And so that's obviously much better for the people providing liquidity to these markets.
Correct. Right. And I think, the other component of that is that it's also better for the people that want to be taking liquidity, because now people won't be as worried about being picked off, or they won't be worried about sort of the adverse selection and flow in that process, the same way they would be with, say, passive liquidity in a lot of these LP instruments. To your point about price discovery, if you think about a simple AMM curve, I say it's simple, for somebody who might not be as familiar with it, it's really reactive liquidity. You either have to be constantly updating or withdrawing your LP position there or adjusting things around it relative to what's happening elsewhere, because chances are for large pairs, liquidity and price discovery is happening mostly on off-chain centralized exchanges, places like Binance. And so instead of doing that, effectively Oracle AMMs and prop AMMs both really allow you to allows that liquidity for the LPs to be more reactive to what's going on in other markets and what's going on where price discovery is happening off chain. And so from an LP perspective, you're less likely to lose money. You're more willing to have more capital, or at least quote wider in a lot of these cases there. And so ultimately it results in tighter spreads for the majority of average users that are trading and using these products. And I think it's an evolution that has kind of uniquely really taken over on Solana just because of the nature of aggregators on Sol. But it's also something that, I think is going to happen on pretty much every other DeFi ecosystem and chain, just because of the nature of market structure around large liquid assets. The long tail is different, and we'll probably get into that in a bit. But for, the Bitcoins of the world and the wrapped equivalents, for, Sol, for ETH, et cetera, and pairs that, are large liquid assets, these types of products are going to be able to provide better liquidity for the majority of users up to a certain extent.
Incubated by Polygon and GSR, Katana is something different, a purpose-built DeFi chain that's focused on giving the best experience possible. It does this by sustainably generating deep liquidity and sustainable real yield. Katana is built from the ground up, with DeFi mechanics to keep your bags from just sitting idle. All you need to do is use your favorite protocol, and Katana mechanisms do the rest of the work for you. Katana is launching with a notable ecosystem of primitives, assets, and partners including Morpho, Sushi, Lombard, Chainlink, and Yearn. Katana is a DeFi-first chain, built for deep liquidity and real yield, by redirecting chain revenue back to active DeFi users. The 1 billion CAT campaign is live. Bridge and deposit directly into vaults in one simple click, and start earning immediately on your ETH, BTC, USD, and more. Thank you to Eigenlayer for making this episode possible. Corporate and protocol treasuries face a major challenge today. Cash and traditional instruments are losing ground to inflation. ETH, SOL, and other proof-of-stake digital assets offer a unique solution. Exposure to the asset's performance, along with access to long-term, sustainable staking rewards that are uncorrelated to traditional interest rates. Using institutional-grade liquid staking tokens unlocks access to capital efficiency for advanced management strategies, while restaking provides the opportunity to participate in the core infrastructure powering the verifiable cloud. For CFOs, DATs, and corporate treasurers, the path to integrating liquid staking and restaking should be risk-managed and aligned with long-term strategic goals. The Productive Treasury Report outlines practical adoption and a forward-looking vision for the role of the modern treasury as a strategic enabler of new technology. Thanks again to Eigenlayer for sponsoring this episode. As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research. Okay, and one piece I want to untangle a little is you mentioned that Oracle AMMs have been around for a while, vis-a-vis things like Liquidity. And I want to dive into that because one thing I don't understand, and I haven't been around Solana as long as you have, is why people didn't do this sooner. Just generally in DeFi, honestly, because AMMs, they're cool, especially like you said, for long tail assets where nobody wants to, provide, do this active market making. It still allows you to have price discovery, but LPs in AMMs suffer this impermanent loss problem where you're actively losing money most of the time if you're trying to provide liquidity to an AMM, and prop AMMs give better spreads to users, and market makers don't lose money so quite as badly, I guess. So why is it that it took until late 2024 for these things to actually take off?
Well, so one thing is just the nature of there's a few things with that, but one is just the nature of where trading volume and where flow goes. And a big thing that's happened in sort of the SOL ecosystem, right, has been the rise of aggregators, mainly Jupiter, but there are others as well, OKX Wallet, Titan, now Camino, and many others, that are sort of owning, if you will, that order flow and routing it to the best place possible for those end users. Prior to sort of those applications really taking off and having the majority of end user volume, it was more a volume thing, right? You can have this better system, you can have this better price, but if it's not good enough, if it's not getting that end user flow, it's just not going to be as competitive as some of the other options there. The other one that I want to pick on is on the LP side. So, it's not that those other LP systems are inherently bad. It's just that reactive or that passive nature means they'll always have more impermanent loss than a more reactive system, or at least should on average over a certain period of time. In practice, though, does that mean they're all going to lose money? It depends, but it's more they won't make as much as some of these other things, and so it's a bit of an efficiency side there. All of that goes to say, though, the rise of really Jupiter and aggregators that have allowed people to plug in these Oracle AMMs and prop AMMs has really been what's enabled that more competitive, open, fairer market for a lot of these assets, and it's something that I think you're going to see recreated not only on other chains, but also on other types of assets that people want to trade. I think there's a lot of design space around this that you'll see on other types of markets beyond just large crypto assets.
Yes, and just to put this in perspective for people here a little bit, anyone who's watching on YouTube or something, I'm just pulling up the Blockworks dashboard for SOL stablecoin swaps. So, very liquid pair that you're trading. If you go back to February of 2024, it's Orca, Liquidity, Radium, Phoenix, Meteora. Big AMM dexes on Solana that everyone knows well. If we fast forward to today, Number 1 is Humidify. Orca's still up there, Radium. Then you have SolFi, Meteora, ZeroFi, Tessera, Lifinity, GoonFi, another Obrick. And you can kind of see this trend where there's a great increase in diversity of which AMMs are getting these SOL stablecoin volumes. It begins kind of, let's call this late 2024, like you said, Chris. And then by February, March, you're seeing SolFi, which we know is built by Ellipsis Labs, kind of a pretty technically complex Solana team that's building an L2 called Atlas. They're doing like almost 50% of volume. And if we go down here, if you look at stablecoin swap, so USDT for USDC or something, yeah, if you go to early 2024, we're looking at Orca, Meteora, Radium. If you go to today, SolFi's number 1, something called Stable, number 2, Obrick, Orca, Radium, Meteora. So that hopefully puts things in context a little bit. As I said, Ellipsis Labs is behind SolFi. The others we don't exactly know. Interestingly, Connor from Temporal went on the Validated pod this week and said that Temporal is behind GoonFi, and that colorful name was chosen after he had beaten Ben, I guess the founder, CEO or something, in a game of chess. And he said you can name the prop AMM, and so he named it GoonFi. I don't know if this is real. This is just what he said on the podcast. I have a Telegram message out asking if it's real, and I'll let you know if I hear more. But just to add some of the human side, Chris, that's one of the interesting pieces about this was for a while it was a mystery. The market structure of Solana completely shifts kind of overnight, and nobody knew who was behind SolFi or the aforementioned GoonFi for a long time. Now people are starting to take credit for these things slowly, but even like Humidify is the biggest one, and as far as I know, that whoever's behind that is not public. So behind closed doors, like, are you aware of who's behind these things? And like, was it known in the Solana Oracle trading infrastructure world sort of who was running these prop AMMs, or were you just like, oh, rando guy is now quoting tighter spreads than anyone else?
Not being specific to us, but to others. I think in general, there's a large community of on-chain investigators that are smart enough to deduce sort of who or what address clusters are associated with each one to some extent. But the joke that I always like to say is don't never ask a man his salary, a woman her age, or a DEX aggregator who's behind a certain prop AMM. And for a variety of reasons, there's a lot of people that would prefer to not expose that. And candidly, there's multiple reasons as to why that'd be the case. But I think one simple one is if you have an edge, and you don't necessarily want people to know that, right? And the traditional sort of HFT trading world is very secretive by default. So it's always interesting to see kind of the crypto crossover, right? Of these firms that previously were extremely quiet, would never even do a press release for that matter, becoming more involved, not just like on chain, but in crypto more broadly. So I do think you'll see more that sort of publicize themselves, particularly given I think a lot of the reg risks are mitigated in the current environment. But there's just that cultural component. I think that more than anything else, people don't really want to talk about it.
So I want to update listeners. I've now heard back from a source that the Temporal GoonFi story is fake. It is fake news. So you heard that here. Scoop on the Lightspeed pod. I don't know if that means Temporal is not behind GoonFi. On a vibes level, I felt like it made sense. They're kind of, I see them as kind of a Zoomer group of cracked devs over there. So it made sense, but perhaps not. Like, who are the so obviously Ellipsis Labs, they do kind of they had this on-chain order book. They're a very obvious candidate to build a Solana prop AMM. They had a deep understanding of Solana market infrastructure, and a lot of people were speculating that SolFi was them when it cropped up as kind of the first really popular prop AMM. Temporal would also make sense. They do sort of transaction landing infrastructure. Like they understand how Solana markets work. Is that are those the kinds of teams that are going to be behind these prop AMMs, or do you think that HFT firms or like I don't know other folks outside of maybe this small Solana trading infrastructure niche are going to get in on the prop AMM game as well?
So I think a lot of it really depends on if you think of what the skill set is required to make this type of product successful, right? There's a lot of Solana specific expertise that's needed. But over time, as more people enter that ecosystem, right, and more people grow familiar with it, and the opportunities kind of sort themselves out, there's a wider pool of people that can participate and build on it. I think if you just like go back to like why did so many firms get involved? Why are so many people trying to build this? It's because a lot of that retail order flow moved on chain. And 2024 and also now in 2025, you've seen a massive amount of trading volume happening on Solana on chain. And so that naturally attracts trading firms, market makers, and others that want to participate in that flow. And by the way, the same can be said about other ecosystems. There are market makers that are actively onboarding to Hyperliquid and other ecosystems the second as well, because there's that flow that is going there and people trading there that makes it profitable for them to market make and take the other side on a lot of these instruments. So I think you're just going to see more and more trading firms get involved. And part of the thing that's really appealing, right, is again, kind of Solana specific, because so much volume is really dominated by Jupiter on the aggregator side. It makes it pretty straightforward, right? There's one party that you need to face, or one party that you really need to onboard and focus on for the majority of the flow. And there are others. You have OKX Wallet, you have Titan, you have Camino, you have others working on these sorts of products. But in general, 90+% of the volume is Jupiter, and so that's really where a lot of these are focusing their attention on. And also, there's an opportunity to provide tighter spreads, or at the very minimum, lay off risk in a more competitive manner on these markets than what they're seeing elsewhere. There was a bit of a meme. I think it might have been Mert or somebody else that tweeted about this, how on-chain spreads on SOL are actually tighter than centralized exchanges for a lot of things. And net of fees, it's definitely the case. And again, obviously it varies, right, on the pair. It varies on the time and sort of what direction that end user might be wanting to do. But I think you're really actually seeing internet capital markets, and you're seeing really efficient DeFi systems out there because of this. The other thing that this type of market infrastructure I think is really going to enable is bringing more liquidity on chain for other assets. And this is part of why I like to say that it's not just prop AMMs. Some of it is also an Oracle AMM. If you think of things like X stocks and sort of these RWA products, the majority of price discovery around those assets is happening off chain. As much as I would love, and I think at some point you will see price discovery move on chain for some of these things, most of it is still happening in sort of TradFi or in other instruments in the off-chain world. And so in that world, having good infrastructure for prop AMMs and Oracle AMMs allows those end users to get better prices, reflects that liquidity that you see off-chain, and provides a better, fairer ecosystem for people to trade and participate in DeFi.
I guess one other thing we should note that you mentioned with Jupiter and aggregators is that you don't trade through a prop AMM. Like as an individual, you're not going to solfi.com and placing a trade. These things plug into the Jupiters and Caminos and Titans and OKXs of the world, and you trade through them that way. So as a user, you would actually never see that these things exist,
right,
except if you looked at the details of your swap. But it's just giving you a better price, and you never actually know or have to know that it's happening on the back end.
And when you think about it, that's how the majority of markets in the real world function, right? And if you think of, you're trading, let's say you're buying Tesla on Robinhood, you don't know if Citadel's on the other side of that trade. You don't know if it's another retail user. You don't know if it's a hedge fund, that's actually fulfilling the order in the back end. There's a million different ways that orders are fulfilled. And ultimately the end user doesn't care as long as they're getting the best price. Now, the interesting component, and this is kind of the other side of Oracle AMMs and DeFi being the way that it is just this ever sort of constant sort of dark forest where you have adversaries at every single angle. And a large reason why these prop AMMs are not exposing their front ends is to mitigate toxic flow. And, again, I depending on how technical the audience is, In general, toxic flow doesn't mean bad. It doesn't mean necessarily illegal. It doesn't mean, what you might think. It just means a trade where the other side of it is informed flow, and you will likely lose money on that. So if you think about it, let's say, a market maker gets an order to sell a large amount of Solana, and there's a lot more behind it. They're breaking it up into chunks. That would be toxic flow if you're providing liquidity on the other side and buying that said SOL, or at least the first few chunks, if it's not priced correctly. And so that type of activity is something that these prop AMMs and really aggregators as well want to try to bifurcate in a manner that is efficient and fair to the most amount of people as possible. And basically, I think the fundamental question, right, is in this type of market, can you give a better price to the end retail user while also accounting for market maker spreads and impacts to their own bottom line on the toxic flow side?
Yeah. I think the toxic flow thing is a really interesting piece. Because AMMs kind of require you to publicly show transactions a bit more than a prop AMM would, right?
Right.
Okay, so as far as like short-term implications, the sort of Blockworks research view that Carlos, who's a frequent guest on the pod, will talk about is that he foresees, and I think this is probably true, more and more meme coin flow is going to go to the Radiums and pump swaps of the world, because they have AMMs that run the traditional way and can price these long tail meme coins that may not even be on Binance or whatever. So there's actually no Oracle price feed to even pipe in for these things. But for liquid assets like SOL or USDC, USDT, you'll see more and more of these volumes go to prop AMMs because they just structurally have an advantage over traditional AMMs and are going to get better prices and are going to win competitively. So that's kind of the basic takeaway you can point out. Chris, I want to ask you, like, what are the larger takeaways? Like, how does this shift the competitive environment on Solana, and how do you see Solana DeFi changing over time as a result of prop AMMs?
Yeah, so I think there's a big asterisk here, which is, will you see a pull Oracle based prop AMM system, evolve on Jupiter or one of these other DEX aggregators? Because it's a low cost, but it's a non-zero cost to maintain these systems, because you're pushing updates, for example, every slot in the case of SOL USDC to maintain these prop AMMs. So that cost inherently limits it to high volume assets where it makes sense to maintain the other side of it, or maybe lower volume, but ones where spreads are large enough to justify that lift. If you move to a pull-based system with some of these, and Switchboard and others such as Pyth have pioneered the pull-based Oracle system, you're able to support at a much lower cost a much broader basket of assets. That combined with things like Jito's BAM mean that it might not just be SOL USDC that you'd see supported or doing the majority of volume for this. You might also see, let's call it mid-cap SPL coins. You'll probably see RWAs and other sort of mirrored assets, if you will, or basket wrapped assets on there. The long tail, though, I think it goes back to, what is that prop AMM doing? What is that Oracle AMM doing? Well, it's trying to relay that off-chain information, whether it's some sort of secret special pricing algorithm, whether it's just mirroring Binance and adding, some sort of skew to it, there's a lot of different ways to configure that each market maker will be different and will have their own unique proprietary edge when they're configuring or building these things. For, a meme coin that just launched yesterday, there isn't really any way that people don't know how to price it, right? And that's, just quite frankly, the truth on some of these stuff is for new assets, particularly, launchpad meme coins where they're just so volatile and primary price discovery is happening on those launchpads. It doesn't make sense as a product there because you don't really have a reference point elsewhere. And even if you do have that reference point elsewhere, the majority of liquidity and price discovery might still be happening on that AMM. And so it's a moot point. So this is part of the reason, right, while you've seen some of the AMMs really focus on launchpads in that. The other category, that I think potentially could change this stuff, but for a variety of reasons right now, I don't think it's going to change the market structure, is kind of RFQs. And so, Jupiter Swap does have an RFQ system. There are other RFQ protocols and platforms out there in the SOL ecosystem and many others. The issue is, an RFQ is more transactions. There are multiple steps, multiple signatures. And for retail end users, there's that UI UX of effectively having to accept a transaction. Now, if you're building a product for this, you always need to have a window in between for an RFQ, right? Where, again, assuming a human user, they need to accept or deny a trade. As part of that, you have to price that optionality, right? A user can say, okay, I'm going to accept this or I'm not going to accept it. In that window, in that pricing, you're skewing your spread to account for that. And because of that, it will almost always be a worse price, all things being equal, than, say, a prop AMM that's constantly being proactive and updating this in that same time period, because it doesn't have that same level of theta decay there. And even if it's really short, even if it's only 5 seconds, 10 seconds, that still adds enough to where it will be less competitive. The asterisk here, though, is there are some market structures that could happen. There are some products that could happen and people could build to make that better. We've talked about this, I think, with a few folks. A last look function, could be something that could make it more competitive, say an RFQ. And then the other thing that, where RFQs can really excel is for like-kind swaps and or large trades that might be capital constrained. Oracle AMMs Oracle and prop AMMs are very, very, very capital efficient relative to the volume numbers that they're doing. But if somebody wants to do, say a very large USDT to USDC trade, you're not really pricing in that price delta. You're really just pricing in the cost of capital, which will vary according to every desk, every single provider at a point in time. And so an RFQ makes a lot of sense, or an auction makes a lot of sense for that type of swap or that type of product. And similar for other like-kind sort of swap assets and low volatility pairs.
And for folks who may not be as familiar, I think a simple way to think of an RFQ would be if an AMM, you just have the trader and the pool. RFQ, kind of trader, pool, and liquidity providers. RFQ, you have this layer in between where the trader can kind of request a quote. That's what it stands for, right? And so, and then market makers sort of compete to fill the price where the trader wants. Is that kind of an accurate?
Yep. Yeah, it's an auction. And that auction, can vary in terms of timing. And there are many different forms of RFQs in crypto, even ones that, are primarily meant for bots, right? But from the most traditional sense, it is that, right? You're having an auction, give me the best price, give me the best fill. And what's happened on Solana is because of the nature of prop AMMs and aggregators, and just the nature of sort of this proactive streaming liquidity, prop AMMs in general have been able to provide better pricing, better fills, and a better experience to end users than RFQs. That's not to say that RFQs won't have a place in the future, but for just the existing sort of suite of the majority of volume going through, say, SOL USDC and large cap pairs, prop AMMs and Oracle AMMs have really changed that game.
Incubated by Polygon and GSR, Katana is something different, a purpose-built DeFi chain that's focused on giving the best experience possible. It does this by sustainably generating deep liquidity and sustainable, real yield. Katana is built from the ground up, with DeFi mechanics to keep your bags from just sitting idle. All you need to do is use your favorite protocol, and Katana mechanisms do the rest of the work for you. Katana is launching with a notable ecosystem of primitives, assets, and partners including Morpho, Sushi, Lombard, Chainlink, and Yearn. Katana is a DeFi-first chain, built for deep liquidity and real yield, by redirecting chain revenue back to active DeFi users. The 1 billion CAT campaign is live. Bridge and deposit directly into vaults in one simple click, and start earning immediately on your ETH, BTC, USD, and more. Thank you to Eigenlayer for making this episode possible. Corporate and protocol treasuries face a major challenge today. Cash and traditional instruments are losing ground to inflation. ETH, SOL, and other proof-of-stake digital assets offer a unique solution. Exposure to the asset's performance, along with access to long-term, sustainable staking rewards that are uncorrelated to traditional interest rates. Using institutional-grade liquid staking tokens unlocks access to capital efficiency for advanced management strategies, while restaking provides the opportunity to participate in the core infrastructure powering the verifiable cloud. For CFOs, DATs, and corporate treasurers, the path to integrating liquid staking and restaking should be risk-managed and aligned with long-term strategic goals. The Productive Treasury Report outlines practical adoption and a forward-looking vision for the role of the modern treasury as a strategic enabler of new technology. Thanks again to Eigenlayer for sponsoring this episode. As always, investments in blockchain technology involve risk. Terms and conditions apply. do your own research. Yes. But let's talk big picture, right? So I think with this landscape we're talking about, I think you could picture a world where every AMM except for maybe PumpSwap, maybe Radium goes away. Maybe Radium goes ahead and launches its own prop AMM. And all sorts of Solana teams begin doing this because everyone wants, a piece of the pie. Everyone creates a DEX aggregator too. And like kind of everyone that's in the middle of these categories gets squeezed out because no one really wants to use them. That if I had to hazard a guess of how things could play out, like that's how I might paint the picture. But how do you sort of foresee the competitive dynamics playing out now that we have this new piece of tech sort of thrown in the mix?
So, the most valuable thing that people are realizing is order flow. And, what if you can own the wallet, if you can own the aggregator, right, that's incredibly valuable because ultimately you have the order flow and you can monetize or direct that to your, preferred choices there. And so from that perspective, right, I would say, well, why would you build a prop AMM? Why wouldn't you just build an aggregator, right? If all things equal, if you have those resources. And this isn't, speaking to any one protocol in particular. This is just kind of a high level, rhetorical question on that. I think it's going to vary depending on each protocol, but AMMs are here to stay, right? They provide a really valuable use case, and for new assets, for the long tail, it's incredibly valuable. And so I think you're going to see, existing AMMs build new products that leverage that unique capability there. I think you'll see some will build prop AMMs, or better said, Oracle AMMs, and I also think others will build aggregators, right? It's the gamut's going to vary, but in terms of them, going away, I don't think they're going to go away. I just think they're going to be more focused on where their best expertise and skill set is.
I guess I'm thinking on the AMM side specifically. It just feels like it's hard to compete in that world because PumpSwap, or Pump Fund is now graduating Pump Fund tokens to its own AMM. And so Radium gets squeezed out, right? And then Radium launches its own launchpad, has a bit of success for a while. But anyone besides them, it's like, what is really the use case? Because most of these short tail meme coin assets are launched on launchpads like Pump Fund. And I don't know if there's necessarily enough new meme coins to support these AMMs otherwise. Like if you look at something like an Orca, Orca actually just launched a meme coin launchpad that it thinks is superior to what's on offer because it's human centered. And so I think that is sort of an acknowledgement that you either need to get a source of long tail assets or you really can't compete. So it would be keeping me up at night if I was running an AMM, this proliferation of prop AMMs that are pricing assets.
Yeah, I mean, as it should. I think it is for a lot of pairs, an existential threat. Now, what I would say is that I think it goes more broadly to sort of, right, what is the edge for a lot of protocols and what is the edge in a lot of DeFi? Ultimately, a lot of things will be competed away. And so, if you're thinking about, what next, right, or what to build, I think you can't just look at that one product or you can't look at that one feature set. You have to think more broadly to what is the, who are the users that protocol is serving or that product is serving, and how can you better suit their needs while still capturing some value there. And that there just isn't a one size fits all answer, right? Every team is different. Every team has different strengths. And so even if, let's say volume on one thing disappears overnight, there might be a new opportunity elsewhere. It'd be remiss to say, look at Mercurial. I don't know if you remember them. Most people don't. But the team behind Mercurial ended up becoming Jupiter and Meteora. And so, a lot of it is just relentlessly shipping and constantly iterating based off user needs.
And what about, I guess, among the prop AMMs? Like, I wonder if longer term, say, Wintermute and Jump and like kind of more sophisticated trading firms or even ones outside of crypto. Like if crypto gets big enough, I don't see why Jane Street or something wouldn't start doing crypto prop AMMs. That I don't think that's a very close future, but like down the line, why not? Do margins get competed to zero basically for these prop AMMs? Like it feels like there's a frenzy right now of trying to get into the game if you can compete, but I just feel like the competitive dynamics of this over time may not. You have to basically take less and less per order, and it's more difficult for market makers to turn a profit, I guess.
Yeah, I mean that's totally fair. I mean that's typically what happens in markets, right? There's a frenzy, spreads are really wide, and then a bunch of people come in, build products or build things in that direction, and then it becomes a much more competitive market, and things tighten up. Sometimes it becomes too competitive, and it becomes unprofitable for people to be in that, and they leave. I do think you're going to see more players in it, just because I think this is a category that's only going to continue to grow. It's just as long as if you can provide a better price while still having an opportunity to make a spread and earn money there, why wouldn't you do it? And so that's, I think, kind of the ecosystem that we're moving in. I'd also just say, as DeFi ecosystems become bigger, traditional trading firms and traditional sort of market participants become more interested and open to participating in it. And, you know, uh, again, like the idea that a lot of these firms would even be trading on chain 5 years ago was, kind of ridiculous compared to the names that you see now. So yeah, I mean, it's just part of the evolution of markets, and the best thing is for the end user, they benefit from it. You as an end user, if you're trading on these assets, you're going to get tighter spreads, you're going to get a better fill, and you have less of a chance of being, some adverse fill on a lot of these products because there's more competition for those orders.
Mm-hmm. Speaking of end users, I mean, do you foresee people trying to build competitors to Jupiter basically, or prop AMMs saying, why am I giving Jupiter all of my order flow that I'm, creating for them? I'm just going to go create a front end for my prop AMM and try to basically, steal some of this order flow from Jupiter.
Yeah, I mean, look, it's definitely possible. I mean, obviously, there are other folks that have built aggregators or are building aggregators. What I would say though is that they're two different businesses. Being in the line of pricing and trading is very different than being in the line of acquiring user retail order flow. Um, Again, I'm not saying that they couldn't. I think there's a lot of great teams out there on the market making side that also have deep go to market expertise and certainly could build really competitive applications there. But ultimately, it's a really hard game. And I think it goes back to sort of that fat wallet thesis that you're seeing in crypto, where the users that control, sorry, the companies, the protocols, et cetera, that control that end user flow are valuable and sort of have the most opportunity in that field. But again, that's a skill set that not everybody has. And so, do I think you'll see other aggregators take substantial market share? Sure. I mean, you've seen OKX Wallet, take a good amount, but it's still a distant second to Jupiter. Even if other ones do take off, though, it's not going to change this market dynamic. You're still going to have a lot of market makers that are interested and other folks, in providing liquidity, providing tighter spreads, and capturing some of that valuable flow as long as it's there. The thing that would make these sorts of products much less interesting and much less attractive is, quite frankly, if volume goes elsewhere or on-chain volume just falls off a cliff. I think that's a much bigger threat than anything else, just given the nature of crypto and just the cyclical volatility. Surviving 2022 and everything there in the SVM ecosystem, I think a lot of people have seen that, have lived through it. And that's sort of, that's the situation where I think people should be concerned, right? Is just volumes go down, not necessarily more competition and spreads go down.
Yeah. That's an interesting point. And I guess I'm curious from your perspective, you did, I believe, sort of market making stuff at Circle back in your day.
Long time ago.
Do prop AMMs give Solana an advantage over other ecosystems now in the trading game? Like, if I wanted to go create prop AMMs on Base or something, or Sui, like, are they now at a disadvantage relative to Solana, or do you think it would be relatively easy to spin up the same thing in a different ecosystem?
Well, so all this goes back to flow, right? Where is the end user flow happening, and what do you need to acquire that? I think Sol's kind of uniquely currently, right? There were just a number of different factors that really made it kind of really interesting for this type of product. But the biggest one is just having end user retail flow primarily flowing through aggregators, and there being kind of an easy synergy to plug into that, in this case, Jupiter. Other ecosystems absolutely are going to have prop AMMs, and some already do. There's a number on, I forget who, somebody, I think, yeah, I don't want to name names, but there are folks that are building and working on that on some of these other ecosystems. It's just the volume numbers and the assets need to justify it, right? And I think also very specifically, it has to be for assets that have a lot of liquidity or price discovery happening off chain. that's where it starts to become the most interesting. I think the other thing, and EVM ecosystems have been a little bit different in this context. Capital efficiency and fragmentation has been, I think, a bigger impact on a lot of these products in those ecosystems than anything else. And so, what's won on the SVM, let's say, of like sort of prop AMMs in terms of volume, on sort of EVM ecosystems, what you've seen is actually a lot of bridges move to this sort of intent swap sort of design. And I'd argue RFQs so far have kind of won on the EVM side. That doesn't mean that you won't see more prop AMMs and Oracle AMMs take more market share on the EVM. It's just they're different markets and the volume is skewed differently.
Yeah, the interesting one that comes to mind for me on the EVM side is Robinhood, which is building an Arbitrum chain. And, Robinhood is famous for this payment for order flow scheme in TradFi that is very lucrative and allows it to offer zero fee trading for retail users. So I wonder, does Robinhood start running a similar kind of payment for order flow, prop AMM like strategy when it brings more trading on chain, supposedly, if that actually ends up happening?
Yeah, I mean, it's definitely possible. It's just really hard to predict a lot of these products until they're out there and people are trading them and using them. The on-chain and off-chain market looked very different 2 years ago than it does today. And so, I'm really skeptical about to really sort of name like, hey, this is going to be big or this isn't, given that.
Yeah, that's super fair. I guess to just make sure we're covering all our bases here, are there other implications when you think long term or you think big picture for what prop MMs are doing to Solana? Is there anything we haven't covered that you think is important to note?
I mean, look, I think the biggest thing is whether or not you see a shift to sort of a pull-based mechanism for these price updates, like you saw on kind of the Oracle side that Switchboard and Pyth pioneered. If you do see that opens up Oracle AMMs and prop AMMs more broadly to just really, effectively support a much broader number of assets in a much more cost-effective way, and opens that up to a lot of competition. I think that component alone would kind of be the single biggest unlock on that. In not just for Sol, by the way, but really for any ecosystem that integrates it. I think the other thing is just a question of, where is trading activity on chain going to happen? Right now, there's a lot happening on Solana. There's a lot happening on Hyperliquid. Is there going to be a new ecosystem, right? I don't know, is Monad or is Mega ETH or somebody else, going to start dominating on-chain volume? And if that happens, right, or BSC or whatever it might be, that alone, those sort of shifts change market structure and will, I don't want to say provoke, but the innovation will follow. Like market makers are going to follow wherever, and traders are going to follow wherever the opportunity is. It doesn't matter the chain. And the joke or a line that I always say is Terra and Luna, RIP, rest in peace. Anchor had terrible UX. If you had to bridge over to it, it was just not a great experience. But they still ended up having $14 billion, I think, at the peak, bridged in Anchor. Why? Because the yield was there and users wanted it. Now, again, I'm not saying that everybody should do that. Don't always follow the yield. Don't always follow the opportunity. Right? Always evaluate it with risk. But I think if the yield is there, if the opportunity is there, if the traders and the people are there, everything else will follow. Good UI and UX helps, but I don't think it's actually as necessary as people think.
So then, how is that game going to be won and lost? I mean, Switchboard is pretty, leveraged on Solana, right? You've placed a bet on Solana functionally with how you've positioned Switchboard, and so in your view, how does Solana keep those volumes up now that it's not the hot new token that's 10xing in a year or whatever it was? How is that game won and lost? So how do you keep that volume from bridging over to Monad once it launches?
Well, one thing I have to really state is Switchboard is a multi-chain protocol, and Switchboard Technology Labs works as one of the core contributors, works with a number of different ecosystems and a number of projects across the board. So
sure.
We're not Sol only per se. What I would say is that we are big fans of high performance chains and high performance ecosystems because we think high performance chains lower the cost of accessing, bring down the barriers, allow for new markets and new products that otherwise aren't possible in other places. Now, I think broadly speaking, most people have realized that, right? Not just with Sol success, but also, Hyperliquid, the big thesis around Monad and some of the work that they've been doing, Mega ETH and many others. Again, I don't want to single out anybody, Aptos, Sensui, et cetera. For Sol and for any chain, it's really about product market fit around the end users, right? Who's building? Are the apps worth using? And are those people going to stick around? We talk about DeFi, and we spent this entire most of this podcast talking about prop AMMs and Oracle AMMs in that context. But it doesn't have to be DeFi use cases, right? It can be gaming. There could be a million other things that users want to use that drive value to chains and drive value to ecosystems. As long as that's there will always be a use case, right? Maybe the core use case, by the way, ends up being the long-term core sustainable use case ends up being payments. And I think you've seen a lot of growth on the stablecoin ecosystem side on a number of different categories. But the one that, I think Akshay and many others have talked about is internet capital markets. And I think you're seeing that really materialize on chain. Pump's raise, if you will, and sale, I think was just incredible to see how much, not judging it one way or another, just the actual size that happened and was fulfilled mainly on chain for it, I think is a big win for the ecosystem and shows you that you can have internet capital markets. You can have people creating and issuing new assets and trading those same assets on chain in a way that is more efficient than, these permission centralized systems.
Mm-hmm. Yeah, I do think the internet capital markets tie-in is interesting. I guess, though, if I were looking for a critique of these prop AMMs, I guess one direction you could go with it is that there are core pieces of Solana infrastructure that are not open source, which arguably go. So you think of like Jito's block engine, right? And they're saying that BAM, once it goes live, is going to be open source, but currently, a core piece of how Solana works is not open source, and that arguably goes against some of the permissionless, more transparent financial system principles that crypto sort of espouses. With prop AMMs, a similar thing is arguably happening, where you have, you mentioned you don't like the name prop AMMs. I think one of the reasons people call them that is because dark AMMs sounds worse. It sounds like it's not transparent. People don't know what's going on behind the scenes with these trading algorithms. And that's absolutely true. And so do you think it's a fair criticism to basically say that this is making Solana market structure more opaque, more TradFi-like, and therefore this is a trend that should be avoided?
Well, right. If you did have all of that exposed, then it would kill the edge. Somebody else would reverse engineer it. And, ultimately they would be the ones getting picked off. I don't. So, look, I'm an idealist. I do think, most things should be open source and should be out there. But there's also kind of one of those things where ultimately this structure allows the average end user to benefit more than if it were forced to be out there. And so just if you think of it from the benefits to the end user, right, the end user gets better fills. They're able to trade more assets in a more liquid manner. And ultimately they're able to participate in the ecosystem in a better way because of it. So, again, I think on the prop AMM side, I just don't see how it could work if it were fully open sourced. Right. And there's also just the question of what do you want to move on chain versus off chain, et cetera. These programs are already structured to be incredibly efficient. If you forced all of it to be open sourced, right, a lot of this logic, a lot of the proprietary things that these market makers or the folks building these prop AMMs are doing would still exist. It would just happen off chain, and it would be more expensive to do it and do the updates on chain.
Yes, I think that's a fair point. And I think I would argue that these prop AMMs are like a good thing and a cool innovation that is driving smaller spreads for users. But wanted to maybe steel man an opposition point real quick.
Totally. Yeah. Look, I think there's definitely arguments around potential malicious behavior, which also one thing, we should note is that Jupiter does, take the process of integrating new prop AMMs very seriously, requires security audits on both sides, and also checks to make sure that, they're not really doing any funky behavior, because that order flow does have valuable information, and, having it and seeing it and exposing it, does open up risks if exposed to bad actors.
Interesting. Yeah.
So there is that, and that's what I would say. Kind of is that. I think there's also the arguments around decentralization, which go in various different forms and arguments. But I think at a high level, those competitive auctions, right? It goes back to like an RFQ, right? Is there a huge difference from a practical perspective of having 10 different prop AMMs all streaming their own prices, all competing for that same order flow, versus 10 different people bidding in an RFQ system? Again, like from an end user perspective, it's effectively the same. The mechanics are different. There's more nuance. There's different components that go into the simulation, but just in general, the end user expects that sort of competitive behavior to get the best fill possible. And prop AMMs and Oracle AMMs enable that.
Mm-hmm. Yeah, totally. The last question I want to ask you, Chris, is just from let's say here to the end of the year, we're about to start, or no, we're not about to start Q4. We're about to enter September, which is in my head Q4. Sort of between now and the end of the year, where is this prop AMM trend going to go? Like, I guess just looking at a more immediate future, what should people in Solana kind of expect to see in this space going forward?
Yeah, I think you'll see a lot more prop AMMs pop up to try to compete for that. And then I think the other thing is, to my point earlier, I think you'll see designs around it change a bit to try to support, especially post BAM and post Up and Glow, assuming it passes. It'll get more efficient, even more efficient, and even more competitive on a lot of this. And hopefully you'll see that kind of pan out, not just for the SOL USDC sort of large cap pairs, but also start to impact the mid cap and just become more efficient overall. Still a lot of asterisks there. And I think a lot of it also depends on what happens to some of the aggregators and where market share goes. But in general, I think as a category, you're just going to see more and more flow go to prop AMMs and Oracle AMMs and less of these like large cap pairs from the existing a lot of the existing AMMs.
Mm-hmm. Yeah, that definitely checks out. Chris, it's been a great conversation. It's been fun diving into one of the real interesting DeFi innovation trends that we've seen over the past year. So really appreciate you taking the time to come chat with me today.
Likewise. Thank you for having me, Jack. And, again, we're really excited about the space. And I think you'll see a lot more folks talking about it over the next few weeks as well.
Yes. Watch this space. Thank you, everyone. If you made it this far into the episode, if you enjoyed it, we would love if you gave a thumbs up or a 5-star wherever you get your podcasts. If you enjoyed this episode, please share it with a friend, and we will see you all again very soon.